Welcome to our deep dive.
Yeah, always excited for these.
Today, we're going to be exploring the world of personal finance
Oh, interesting.
and the psychology behind, our money decisions.
I like it.
You submitted The Psychology of Money by Morgan Housel,
Yeah.
and we're really excited to unpack some of the key ideas from the book with Yoss.
Sounds good.
It's not always about crunching numbers and complex formulas, right?
Great.
It's about understanding the human side of money.
The human side, yeah, that's fascinating how our emotions and biases and personal stories really shape the way we think about and manage our finances.
Totally. And Housel really drives this point home with a story about a tech millionaire
Oh, wow.
with, terrible financial habits.
Okay.
This guy had all the money in the world,
Yeah.
but flaunted his wealth, made impulsive decisions, even carried around a stack of $100 bills to show off.
Oh, really?
Yeah, just to show it off.
Wow,
It's crazy.
that really highlights the book's central theme, though, right? Everyone's relationship with money is unique and deeply rooted in their personal experiences.
For sure.
Someone who grew up during a recession, they might be super cautious with spending.
Right.
While someone who experienced an economic boom, they might be more comfortable taking risks.
Yeah, it makes you think about all the different ways people view money.
Mm-hmm.
Like someone who lived through the Great Depression probably has a completely different perspective on saving and investing than someone who came of age during, the dot-com bubble of the 90s.
Yeah, and these differences aren't just anecdotal.
Go on.
Research by Ulrich Malmendier and Stefan Nagel found that people who live through periods of high inflation,
Interesting.
they tend to expect higher inflation in the future, right?
Oh, okay.
Which makes them less likely to invest in bonds.
Interesting.
So your personal history really does shape your financial outlook.
That's a great example.
Yeah.
It's not just about your age. It's about the specific financial environment you were exposed to growing up.
Right.
And get this even played a role in American politics.
Oh, really?
Back in the 1960 presidential election, John F. Kennedy's lack of personal experience with the Depression was a talking point.
Wow.
Yeah.
Voters wondered if he could truly understand the economic anxieties of everyday Americans if he had never personally struggled during those times.
Right.
It's a reminder that our past experiences, especially when it comes to money, can have a lasting impact on our beliefs and actions.
Absolutely. Speaking of experiences,
Yeah.
Housel dives into the often overlooked roles of luck and risk in financial success.
Okay.
He uses these contrasting stories of Bill Gates
Oh, okay.
and his equally talented friend, Kent Evans.
I don't know that story.
Both were brilliant. Young programmers attending this same elite high school
Mm-hmm.
had access to the same cutting edge computers,
Wow.
and yet their lives took very different paths. Gates obviously went on to co-found Microsoft and become one of the wealthiest people in the world,
Of course.
while Evans tragically died in a mountaineering accident at a young age.
Oh, wow. I didn't know that.
Yeah, it's a powerful reminder that while hard work and talent are crucial, luck and the unpredictable nature of risk also play a huge role.
It's easy to forget that.
Yeah, we often fall into the trap of survivorship bias, right?
Totally.
We focus on the winners,
Yeah.
try to replicate their strategy.
Right. Just follow what they did.
But we forget that luck often plays a big role.
Absolutely. So instead of searching for this magic formula
Right.
based on outlier success stories, it's important to look for, broader patterns and principles that contribute to sound financial decision making.
Okay. Yeah, makes sense.
And this leads to a great story from the book, actually, about John Bogle.
The Vanguard founder.
Yeah, the founder of Vanguard. He was at a party hosted by this billionaire
Okay.
and overheard a conversation between Kurt Vonnegut
Wow.
and Joseph Heller.
Okay, this is getting good.
So Vonnegut pointed out to Heller that their billionaire host had more money than Heller would ever make.
I can imagine.
But Heller's response was brilliant. He said, "Yes, but I have something he will never have. Enough."
That story really got me thinking.
Mm-hmm.
We often get caught up in chasing more and more money. But what if the real key to financial well-being lies in defining what enough means for us personally?
It's so true.
What is enough for you?
Yeah, it's such a simple but powerful idea, having clearly defined financial goals and recognizing when you've reached a point of satisfaction that can lead to greater happiness and less stress.
For sure.
It's a crucial part of maintaining long-term financial and emotional well-being.
Right.
Constantly chasing this moving target can lead to, unnecessary risks and dissatisfaction.
Totally.
So
Okay.
yeah, figuring out what enough is for you is so important.
Yeah, I think that's great advice.
I think so too.
Anything else to add on this?
Not on that. I think we covered that pretty well.
Great.
Should we move on?
Yeah, let's move on to the next topic.
Yeah.
So understanding our personal history and defining our enough, both so crucial.
Yeah.
But the book doesn't stop there.
No, it doesn't.
It also dives into this fascinating and often misunderstood world
Yeah.
of compounding.
Oh, compounding. Yeah, it's such a powerful force. And Housel uses a great analogy to explain it.
Okay, I'm intrigued.
A snowball rolling down a hill.
I love that.
Right.
As the snowball rolls,
Yeah.
it picks up more snow, becoming larger and more powerful over time.
Exactly. That's the magic of compounding. Consistent, even small gains over a long period can lead to exponential growth.
It's amazing how it works, right?
It really is.
And when it comes to compounding,
Yeah.
there's no better example than Warren Buffett.
Oh, of course, the OG.
Buffett's known for his, incredible investing skills.
Right?
But the book highlights something even more important,
What's that?
the power of time.
Time. Yeah.
He's been investing consistently for over 70 years.
It's incredible. Just think about that.
That's a long time.
Imagine if Buffett had started investing in his 30s and retired at like a typical age.
His net worth would be significantly lower.
Exactly. The book makes a great point.
What's that?
It's not about hitting home runs with risky investments. It's about consistently getting on base and staying in the game for the long haul.
Consistency and patience.
Yeah. Yes. Those are more important than brilliance when it comes to building lasting wealth.
And the book actually contrasts Buffett's approach with that of Jesse Livermore,
Oh, yeah. Livermore.
a brilliant but ultimately tragic figure in financial history.
Yeah. He's a fascinating case study.
Livermore made and lost fortunes through, risky speculation.
Right.
He was a brilliant trader, but lacked the discipline to let compounding work its magic.
He just couldn't resist chasing the next big win,
It's like he got bored with slow and steady.
It really makes you think.
It does.
Maybe we should all focus on building a solid foundation and sticking with it rather than always trying to outsmart the market.
Right. Right. And this long-term perspective actually ties into another concept Housel discusses.
Tell me about it.
The importance of room for error.
Ah, yes, room for error. That's so important. He explains it using expert blackjack players as an example.
Okay.
Even when they have a statistical edge, they never bet their entire bankroll on a single hand.
So it's like having a financial cushion, right?
Exactly. It's about recognizing that life,
And the markets?
and the markets are unpredictable.
For sure.
Having emergency funds, avoiding excessive debt, diversifying your investments.
Yeah.
These are all ways to create that buffer.
So you're not completely wiped out if things don't go as planned.
Right. It's about protecting yourself and weathering the inevitable ups and downs.
Yeah, I like that. Weathering the storm.
Remember, Bill Gates famously kept enough cash on hand to cover a year of payroll at Microsoft.
Wow. Even one of the world's most successful companies understood the need for a financial safety net.
Exactly. And that brings us to another important point. Having that financial buffer isn't just about covering unexpected expenses.
Oh, so there's more.
It's also about having the freedom to pursue what truly matters to you.
That reminds me of the idea of finding your own enough
Yeah.
and recognizing the true value of time.
It's something we often forget. True wealth isn't about fancy cars or expensive clothes. It's about having options and control over your time.
It's about owning assets that haven't yet been converted into material possessions.
Exactly.
Early in my career, I was obsessed with becoming an investment banker.
Really?
Yeah, I thought a big salary was the key to happiness.
That's a common misconception.
Right. But I interned at an investment bank
Uh-huh.
and quickly realized the trade-off: grueling hours, constant pressure, and very little control over my time.
Yeah, it's not all it's cracked up to be.
It made me question if that path was truly aligned with what I valued most.
Good for you for realizing that.
Yeah, it was a good learning experience.
That's such an important realization. We often equate wealth with a high income, but forget that true wealth is about having control over your most valuable asset, your time.
Your time.
Especially in today's world where everything is moving so fast. Flexibility and control over your time are incredibly valuable.
Absolutely. It allows you to adapt to changing circumstances, pursue your passions, spend time with loved ones, things that money can't buy.
Couldn't agree more. And the book actually brings up Rihanna as an example.
Oh, really?
I know, surprising, right?
Yeah, I wouldn't have expected that.
Despite being a wealthy celebrity, she faced financial struggles due to overspending.
It just goes to show you, even those with high incomes can fall into the trap of chasing material possessions.
And sacrificing control over their time.
Exactly. And that takes us to another interesting idea from the book.
Oh, let's hear it.
Embracing reasonableness over cold rationality.
Wait, are you saying we shouldn't always strive to make perfectly rational financial decisions?
Well, not necessarily. The book suggests that trying to be perfectly rational can actually be counterproductive at times.
How so?
Housel tells this fascinating story about Julius Wagner-Jarrick,
Okay.
a Nobel Prize-winning doctor.
Impressive.
He was treating patients with syphilis,
Uh-huh.
which is, obviously a devastating disease.
Of course.
And he discovered that patients who developed high fevers often saw their symptoms improve.
Interesting. So what did he do?
He started intentionally infecting his patients with malaria.
What? To induce fevers?
Yeah.
That sounds crazy.
It does sound counterintuitive, right?
Yeah.
But Wagner-Jarrick recognized that fever, while uncomfortable, played a role in fighting infection.
So this approach, though risky, led to a breakthrough in treating syphilis.
It did. So, okay, you're probably thinking, what does this have to do with money?
Yeah, I was just thinking that.
Well, just like we often fear fevers, even though they can be beneficial, we often shy away from financial strategies that feel uncomfortable in the short term.
That's a good point. I never thought of it that way.
Saving aggressively or investing in a down market can be scary,
Yeah.
but they're often the best paths to long-term financial goals.
So sometimes making financial decisions that feel a bit uncomfortable in the present can actually lead to greater rewards in the future.
Like delaying gratification. It's not always fun,
Right.
but often necessary.
The book even mentions Harry Markowitz.
Oh, the economist.
Yeah, a Nobel Prize winner in economics. He developed a mathematical model for optimal portfolio allocation, but for his personal investments, he chose a simpler, less optimal approach.
But even the experts sometimes recognize that real-life financial decisions involve emotions.
Personal circumstances.
Yeah, and a need for simplicity that can't always be captured in a complex model.
Absolutely. It's about finding what works for you and your unique situation. And that leads us to another compelling idea from the book,
Okay, what is it?
the seductive power of narratives.
Oh yeah, I remember this one. The book tells this story about a Russian professor who predicted the collapse of the U.S. economy back in 2008.
Oh, yeah.
And even though his prediction was based on pretty flimsy evidence, it gained traction because it tapped into people's anxieties, especially during a time of economic uncertainty.
Right. It shows how narratives, even those based on flawed logic or data, can heavily influence our perceptions and decisions.
So why are we so easily swayed, especially by these negative predictions?
Well, negative events tend to happen suddenly and
Yeah.
dramatically.
They grab our attention.
Exactly, and they make a lasting impression.
It's like that saying, the stock market takes the stairs up,
Yeah.
the elevator down.
Exactly. A 40% market drop makes headlines.
Yeah.
But a gradual 140% gain over a few years often goes unnoticed.
So we tend to overestimate the likelihood of negative events because they are more vivid in our memory.
Exactly.
And that brings us to Housel's thought experiment.
Oh, yeah, I love this one.
Imagine an alien visiting Earth in 2007, and then again in 2009.
So right before and right after the financial crisis.
Right. Despite the fact that the underlying economic conditions were roughly the same in both years, the prevailing narrative had completely shifted.
In 2007, there was widespread optimism.
Yeah.
By 2009, fear and pessimism dominated.
Our alien friend would be puzzled by this disconnect between the reality and the story being told.
Totally. And that story, that shift in narrative, ultimately led to a massive decline in wealth as fear drove investors to make irrational decisions.
Fear is a powerful motivator.
It really is.
So how do we protect ourselves from falling prey to these narratives,
Yeah, especially the negative ones.
especially the negative ones, right?
The book suggests developing a healthy skepticism towards dramatic predictions
Okay.
and remembering that markets are complex, adaptable systems.
Right.
They recover and evolve over time. Things rarely unfold in a straight line.
So we shouldn't let short-term volatility overshadow long-term potential.
Right. And always remember, the most important investment you can make is in understanding yourself.
Wow, this deep dive into the psychology of money has really been eye-opening.
He really has.
There are so many valuable insights about, how our minds work when it comes to finances.
For sure.
What do you think are the most important takeaways for our listener?
I think the biggest takeaway is that there's no one-size-fits-all approach to money. Personal finance is deeply personal.
Yeah, it's not just about the numbers.
Right.
It's about understanding your own values, experiences, and goals,
Exactly.
and recognizing those often irrational forces that drive our financial decisions.
Because we're not always as rational as we think we are.
That's for sure. So for our listener out there, as they continue on their financial journey, what the one question they should be asking themselves?
What stories are you telling yourself about money?
Oh, interesting.
Yeah, and the follow-up to that is, are they helping or hindering your financial well-being?
That's a powerful question. Like, are we letting fear and pessimism hold us back from taking, calculated risks?
Right.
Are we chasing unrealistic expectations instead of focusing on what truly matters?
It all comes back to those narratives we create, and sometimes they can really lead us astray.
Yeah, for sure. So it's really about being mindful of those stories and questioning whether they're serving us.
Exactly. It's a process of self-reflection and adjustment, and it's important to remember that you don't have to figure it all out on your own.
Right.
There are resources, communities, and experts who can guide you along the way.
And we're happy to be a part of that journey with you.
Absolutely.
We hope this deep dive is giving you some new perspectives on, the psychology of money.
For sure. Always more to learn.
And remember, financial success isn't just about the destination.
It's about the journey.
It's about enjoying the journey and making choices that align with your values.
Thanks for joining us.
That's a wrap on this deep dive.
Until next time.
We'll be back next week to explore another topic. Until then, keep learning, keep exploring, and keep those financial goalposts in check.